Good evening, ladies and gentlemen, and welcome to our class on MACD, Moving Average Convergence and Divergence, sponsored tonight by Trade Time, one of the world's leading providers of Forex and CFD trading. When you trade with Trade Time, you have a very unique opportunity to customize your entire account to fit your trading style as well as your personality. You also get advanced trading tools. Your funds are secured in segregated accounts, and you get their proprietary Trade Time next generation trading platform. As you can see, everything is dynamic and easy on the eye, developed for traders to look at and use easily. Trade Time's platform is intuitive and trader friendly. They offer advanced charts and indicators. They customize alerts to your needs, and you can also use one-click trading. Now, you also get free signals pushed out to your platform, but not only do they give you the asset, they give you the direction, what price to buy it at, where to place your order, what the first objective is, what the second is, where you should place your stop loss, and you can see all the other traders or the number of other traders that are following that same signal or trading that signal on the platform. And if you wish to trade it, you only have to click on Seize the Moment, and it'll open a position for you. So you simply just tell it how much funds you want to invest. Now, if you like, during our class tonight on MACD, you can go to www.tradetime.com and customize a demo platform. There's no credit card, no deposit required, and you can follow along using your advanced charts as we learn how to use MACD. So when you get started, you can see the next generation platform, and you see how easy it is to use those charts, and it's to trade directly from the chart on their platform. Now, tonight's class is being recorded, and you can access a recorded version of tonight's class in about 24 hours by using the same link to come to tonight's class. And in a short time down the road, it will also post it to investing.com. If you go to www.investing.com, where you went to enroll in the webinar, go to the education tab and then go to webinar on demand, and you can all the classes we've ever offered there and watch them at your convenience. Now, MACD, which is my favorite trading indicator, I like saying it, MACD, Moving Average Convergence and Divergence, was developed by Gerald Up in the late 70s. And if we think about 1970, that's almost 4 years ago, we didn't have online, we didn't have Forex trading, we didn't have CFDs, but it happens to be that MACD fits into any type of trading style, short-term or long-term, and whatever asset you wish to trade in the liquid financial markets. Now, moving average convergence and divergence indicator is actually one of the most commonly used momentum indicators around. It is used as changes in the strength, direction, momentum, and duration of a trend. So it's going to give you a lot of pieces of information from one indicator. Now, MACD is one of the most popular and broadly used indicators in forex trading. The letters MACD is an abbreviation for Moving Average Convergence Divergence. The MACD indicator, which requires moving averages as input, falls into the group of lagging indicators. Now, a lot of people hear the word lagging, that's a negative connotation. It isn't. You have leading indicators and lagging indicators. Leading indicators are very rare, but a leading indicator tells you or predicts something's about to happen. A lagging indicator tells you it has happened. So imagine shooting a rocket into the sky. At a given point, it's going to lose its momentum and turn back down to Earth. A leading indicator simply tells you it's losing its momentum. A lagging indicator tells you it lost its momentum and turned back to Earth. This is the difference in the function of the MACD indicator is to discover new trends and to help identify the end of the current trend. There are various ways to gauge the signal generated by MACD, and many traders use their own unique settings and methods around this indicator. Now, trading divergence is one of the most popular ways used by MACD. But unfortunately, the divergence trade is not that accurate. It fails more times than it succeeds, but it does give you some indication of that you should be watching for something. To explore what a more logical method of trading MACD divergence, we'll look at using the MACD histogram as we get through the class tonight. Now, the MACD indicator is typically placed on the bottom of the trading chart in a separate window beneath the price action. The moving average convergence and divergence tool is a relatively easy tool. However, it is crucial to understand it fully before attempting to use its signals. Now, I'll try to apologize right now for this, because tonight we have to learn how all the calculations are done. You'll never ever have to calculate MACD. It's so popular, every charting service will drop it on there. But if you just drop it on there, you have no idea what the lines mean, where they're coming from. So therefore, you don't know they're giving you false information and good information. And you have to understand where all these lines come from. Once we do, you'll never have to do it again. But you need to fully understand where this comes from. So the concept, and because this, MACD is a 6-step divergence. So you have 6 different steps that we have to go through. Okay. Now so it's wordy, and I'm going to try to make it interesting and show it to you on charts. But I'm apologizing now because it is wordy. So the concept behind MACD is fairly straightforward. It calculates the difference between an instrument's 26-day and 12-day exponential moving average. Of the 2 moving averages that make up the MACD, the 12-day or 12-period EMA is obviously the faster one. Now, I'm going to have to explain this to you because most of you don't understand what the difference is between a faster and a slower moving average. So imagine a moving average, and an exponential moving average simply gives a little bit more value to the most current prices. It weights the current prices. Now, if we were to look at a 12-day, or let's forget MACD, we're looking at a 10-period moving average and a 30-period moving average. To get the 10-period moving average, we'd add the current price plus 9 prices back, and we're looking at a 15-minute chart, 9 15-minute periods, add them together, divide it by 10, and we would have the current moving average. If we were also to look at that as a 30-period moving average, we'd look at the current period and 29 periods back, divide that by 30. So which would be the faster and the slower? Okay. Not just for MACD, this is in any type of moving averages. If you're using moving average crossovers, you're using multiple moving averages. The faster moving average is always the shorter period, because the shorter the period, the more it reacts to the faster it reacts to changes in the most current prices. A 30 period would react slower because you're using the current price plus back 30. If you're using a 10 period, the current price plus the last 9 periods, so it would react faster. So always the smaller number is considered the faster, and the longer number is considered the slower. Now, there's lots of things out there that use 3 moving averages. So you would have the faster, the medium, and the slower based on the number of periods. So in their calculation of their values, both moving averages use the closing price of whatever period is measured. On the MACD chart, a 9-day EMA of the MACD itself is then plotted, and it acts as a trigger for buy and sell signals. Okay, so let's go do this on a chart. Let me pop up some charts on your screen here for you. So the first thing we do is we use a 20 period and a 12 period, a 12 period and a 26 period EMA. So an EMA is simply a weighted moving average, and we get these by just going down to our indicators, locate our moving average, and take our exponential moving average. Now, we're going to put two of these on our charts. So we're going to take the first one, and we're going to set that to a 12 period moving average. So we're going to make that blue. We're going to make the input at 12, because that's the standard that Gerald Arpel developed this for. So if you're using all of his standards, then you know you can use all of the standardized interpretations and strategies. So we've got our, so then we have to add on to our chart the second moving average, or the slower one, which is a 26 period moving average. And we're going to make that gold so we can see them easy on our charts. So what we see on our charts are the two moving averages. Now, MACD doesn't use these moving averages except as part of their calculation, because MACD is always dropped on the bottom of the charts. So what MACD does is these are the first derivatives, because a derivative is simply a step away from current price. So it used the current price to develop the two, or to place the two EMAs on our chart. What it does now, it subtracts the shorter period EMA from the longer period EMA to give us what's called the MACD line. Okay. So we're going to go drop our MACD on our chart. Come on, where's my MACD? On our chart. And the MACD is placed at the bottom of our chart. So let's go set this up here for us. I'm going to take off the histogram. I'm going to take off the signal line, because the only thing we're concerned with right now is the MACD line. I'm going to make this dark blue. And this MACD line is the difference between this line and this line. Okay. The blue line here is our shorter EMA. Our gold line is the longer EMA. The MACD line down below is dropped on a chart below the price action, starting with a 0 line. And the difference between these two lines, the MACD, the shorter period minus the longer period, is then dropped on the chart below. So what does it tell you to begin with? When the shorter period EMA crosses the longer period EMA, they would always be what? If it's the exact same number minus the exact same number, they're always going to be 0. So wherever there's a crossover, it's always a 0. So basically, if we look at the bottom line, every time price is at 0, we know the shorter and the longer EMAs are crossing each other. When the longer term EMA, or the slower EMA, is larger than the short term EMA, the price, the MACD line down below, will be below 0, would be a negative number. When the shorter EMA is above 0. That means it would be a positive number or above 0. So what do we have? Our MACD histogram, our MACD line down below, tells us the entire story of these two EMA lines. So in a downtrend, we would expect to see price or the MACD line moving downward. As price eases out and moves into a uptrend, we would expect it to move above 0. Anytime it's at 0, we know that the short-term and the long-term EMA are crossing one another. So we can now get rid of the EMAs or the moving averages on the price chart because MACD doesn't put those on the price chart. It only calculates them to come up with the MACD line down below. Now, if we were to use this MACD line down below, we would be simply trading with simply a moving average crossover. That's not such a good indicator. We could just use those all the time we want. So MACD goes one step farther. So we are now on the second derivative, moving to the third. Because the first derivative was the two EMAs. The next derivative, which is derived from those, was the MACD line, which is the difference between those two. The third line on the MACD line is called a trigger line. This trigger line, or the signal line, we're going to make that in red, is a 9-period I'm sorry, I just want to make this red line bolder here for us. Okay, is a 9-period moving average of the MACD line. So the blue line is our MACD line. The red line is called our trigger line or our signal line. And it is derived by taking a 9-period EMA of the MACD line. So it's a 9 EMA of the blue line. And it is called a signal line. When the MACD line and the signal line cross each other, it gives us what's called transaction signals, buy and sell alerts. Okay, now, this could be put on the MACD chart because now we're getting simple crossovers, but we're getting crossovers not of the moving average, we're getting the crossovers of the moving average difference with a 9-period EMA as the signal line. But we're going to go one step farther. We're going to add on to our MACD line, our MACD chart, what's called a histogram. Let's make this in bright gold for you. Now these can be any colors you want, just so you know what the colors stand for. The MACD histogram is simply the difference between the MACD line and the MACD trigger line. Because when the MACD line and the MACD trigger line cross each other, what is their value? 0. When the MACD line is bigger than the MACD trigger line, it's a positive value. So we can see in the histogram how positive that is. And if it's a MACD, the short term, the signal line is crossing the other way, it's a negative or a peak and a valley. And we can see the depths of these peaks and valleys in this histogram. And that is the basics of putting the MACD on your chart and being able to start reading it, not making trading decisions, just reading it. So you know where these lines come from. Now, the fact is you can use simply the histogram and get rid of all the other lines. So now let's talk about what we do with these now that we have them on a chart. Now, you don't ever have to do anything. All you do is click on the indicator, click on MACD, and all of this is dropped on the chart for you. Okay, so there's nothing you have to do once you now know how or where they all come from. So the MACD histogram is just an elegant visual representation of the difference between the MACD and its 9-day EMA. The histogram is positive when the MACD is above its 9-day EMA and negative when the MACD is below its 9-day EMA. If prices are rising, the histogram grows larger as the speed of the price movement accelerates. Okay, understand this. If prices are rising, the histogram grows larger as the speed of the price movement accelerates and contracts as the price movement decelerates. Doesn't say what price it's at. It's based on the acceleration and the momentum of the price move. The same principle works in reverse as prices are falling. Now, the MACD indicator is both a momentum oscillator and a price-based oscillator, and is one of the most reliable studies we have. While it is a lagging indicator, it works well in all time frames and with all stocks and futures contracts. It is a highly interpretive probability signal that is based on the differences existing between 3 moving averages and its histogram. While it is slower than a momentum indicator such as stochastics or RSI, if you are willing to sacrifice a little speed in exchange for safety, it is good at keeping you on the right side of the market. Now, I've given you in tonight's class a handout. This handout is only available in class, and it goes over all of this we've talked about and explains it all. Because like I said, I know it's a little bit wordy, but there's no other way to do this than go through the words. Now, MACD is perhaps the best all-around study available. In downtrending markets, the fast-moving average will move down faster than the slow-moving average. As the fast-moving average diverges from the slow-moving average, the MACD will illustrate that relationship. And in uptrending markets, the 12-period EMA should move up faster than the 26 period. As such, the MACD will move higher to express the growing difference between the 12 and the 26. The graphic above will illustrate this relationship with the 12 and the 26 period EMAs on the chart, along with the MACD using the 12 and the 26. So on the top, you can see these two EMAs on the chart, and you see what happens when we see it on the bottom. So notice the MACD helped traders notice that the trend change from the very early stages as the blue boxes above began before the downtrend was completely finished. This is a key part of the indicator and something we will delve into deeper, okay, using MACD as a trigger into trades. But before we got to that, you probably noticed the 0 line drawn on the MACD indicator. This is the key part of the indicator as it shows us where there is no difference between the EMAs. So when the lines below are at the 0 line, we know that the MACD lines are equal. So we're expecting a crossover in one direction to the other. MACD will cross the 0 line as the fast moving average intersects the slow. Okay. Now the signal line, okay, or the trigger line, this is where it comes into play. The signal line is a moving average built on the value of the MACD. By default, the value is 9 periods. Building on the relation of the MACD line itself, traders will often look for entry opportunities when MACD crosses its signal line. When the MACD crosses its signal line, it generates a buy signal. When it crosses above and over the signal, it's looked at as a signal to buy. When the MACD crosses below the signal, it is often looked as a signal to sell. So you can also see that on the histogram. When the histogram is at 0 and then moves upward, it's telling you to buy. When the MACD histogram is at 0 and moving downward, it tells you to sell. Now, these are only transaction signals. In an effort to more closely follow the relationship of the MACD and the signal line, traders can follow the histogram, which is simply a bar chart plotted around the 0 line to indicate the relationship between the MACD and the signal line. Now, MACD actually gives us 3 different stories, 3 different pieces of information. As the name says, where the moving average convergence and divergence. So what it gives us is crossovers, overbought and oversold conditions, and divergences. Now, the first are crossovers. The basic MACD trading rule is to sell when the MACD falls below its signal line. Similarly, a buy signal occurs when the MACD line rises above its signal line. So in other words, when the signal line is smaller than the MACD line, it will reach crossover 0 and then will get larger in the histogram. That will give you a buy signal. When it crosses below and falls downward, it's giving you a sell signal. It will also give us overbought and oversold conditions. When the shorter moving average pulls dramatically away from the longer moving average, in other words, the MACD rises, it is likely that the symbol price is overextending and will soon return to its normal realistic zones. So what we're looking for is the MACD line, not the signal line, to rise extensively. An indication that an end of the current trend may occur when the MACD diverges from a symbol. Now, divergence occurs when we see that the MACD line is making higher lows while price itself is making lower lows. So what we see is the indicator is moving on an upward value while price is moving on a downward value. When we get the crossover, it's giving us a signal for a breakout, and combine the divergence with the breakout, the crossover, it's giving us a very bullish signal. The opposite is true for a bearish divergence. A bearish divergence forms when a security records higher highs and the MACD line forms lower highs. The higher high in the security is normally for an uptrend, but the lower high in the MACD shows less upside momentum. Even though upside momentum may be less, upside momentum is still outpacing downside momentum as long as the MACD is positive. Waning upward momentum can sometimes foreshadow a trend reversal or a sizable decline in price. So when we're looking at the MACD and making the histogram, we got 4 derivatives. The MACD histogram is an indicator of an indicator. In fact, MACD is also an indicator of an indicator. This means that the MACD histogram is 4 steps removed from the price of the underlying security. So we started out with the first derivative, which was the 12-period EMA and the 26-period EMA. The second derivative was the MACD 12 EMA minus the 26-period EMA, which gave us the MACD line below. The third derivative was the MACD signal line, which was the 9-day or 9-period EMA of the MACD line. The fourth derivative was the MACD histogram, which is the MACD line less its signal line. So the base of the indicator is the security price. It takes 4 steps to get the actual price to the histogram. So let's go over and look at this histogram again on the chart. Technically, we could come and do away with the MACD line and the MACD signal line and see everything we need to see right on this histogram. Because now we don't have any EMAs on the price chart here. We don't have a signal line and we don't have a MACD line here, a trigger line. Because what happens is all of this is calculated down, and when that MACD line crosses the trigger line, it's always at 0. So at this 0 point on this 0 line, and this is the 0 line, at this point, every time it crosses over, it's either generating buy or sell signal. Here it crossed over and down. It gave us a sell signal. Here it crossed over and moved up. It gave us a buy signal. The higher the peaks and the troughs are, the more it's giving us a divergence signal, okay, because it's spreading out farther and farther and farther. But we can see exactly here what is happening in the momentum of the downward movement. Here we see an uptrend and a peak, and we really got nothing because it moved into congestion. And as we can see, it kind of just held in this congestion. Here we move into a very strong downward trend, and then we moved into some sideways congestion here, and now we're getting the trend confirmed moving along. So you can trade simply from the histogram. I'm sorry, just let me get my. So as with MACD, the MACD histogram is also designed to identify divergence, convergence, and crossovers. The MACD histogram, however, is measuring the distance between the MACD and its signal line. The histogram is positive when the MACD is above its signal line. Positive values increases the MACD diverges further from its signal line. The MACD histogram crosses the 0 line as MACD crosses below its signal line, and the indicator is negative when the MACD is below its signal line. Negative values increases MACD diverges further from its signal line. Conversely, a negative value decreases as MACD convergence on its signal line. Now, transaction signals. A lot of us call these buy and sell signals. Okay. Some people call them entry signals. I like to use the term transaction signals because they actually aren't buys. They're giving us a possible transaction. It has become standard to plot a separate moving average alongside the MACD, which is the signal line, also known as the trigger line. This is found plotted alongside the indicator and chart. And as you can see, the transaction signals are generated when the MACD line crosses through its trigger or signal line. The basic rule of thumb is the basic bullish signal or buy signal occurs when the MACD line crosses above its signal line. Traders who attempt to profit from bullish MACD crosses that occur when the indicator is below zero should be aware that they are attempting to profit from a change. So we want to see the crossover occur and move above the zero levels. But that center line is very important. As mentioned earlier, the MACD indicator is calculated by taking the difference between the short-term moving average and the long-term. Given this construction, the value of the MACD indicator must be equal to zero each time the two moving averages cross each other. A cross through the zero line is a very simple method that can be used to identify the direction of a trend and the key points when momentum is building. The biggest drawback of using this indicator generated transaction signal is that a trader can get whipsawed in and out of a position several times. And this is one of the drawbacks that you should be aware of. Because even though it generates these transaction signals, it doesn't tell you how far that price movement is. And when you're covering the spread, and you can get whipsawed in because he can give you a sell signal, then a buy signal, then a sell signal. Okay, the fact is, you still have to apply other indicators and risk management to see if it's worth generating that trade. Because again, it's giving you bullish and bearish signals, but it's not telling you it's a signal, how long that signal lasts or how far that asset might move. So you could get a lot of unimpressive gains and even small losses during a hardcore rally. Traders should be aware that the whipsaw effect can be severe in both trending and range-bound markets because relatively small movements can cause indicators to change directions quickly. A large number of false signals can result in the trader taking many losses. When commissions or spreads are factored into the equation, the strategy can become very expensive. But in conclusion, the MACD indicator is the most popular tool in technical analysis. It, RSI, and stochastic are the three primary trading indicators that are used in the marketplace. The clear transaction signals help minimize the subjectivity involved in trading, and the crossovers, the signal line, make it easy for traders to ensure they are trading in the direction of the momentum. Very few indicators in technical analysis have proved to be more reliable than MACD, and this is a relatively simple indicator can be quickly incorporated into your short-term trading strategy. So if there was ever a quest in the world of investing for the Holy Grail, it would be acquiring the ability to spot trend changes. There are not many ways investors attempt to do this with varying degrees of success, but a common trend tracking tool like the two lines of the MACD convergence and divergence. This tool measures the stock's momentum and can aid investors in spotting changes in market sentiment. So just like in physics, momentum changes occur before the price of an asset changes. MACD will help you see the change in this momentum. So the strength of the current trend can be measured by channeling the MACD. Spot trend reversals by looking for divergence in momentum as measured in the MACD. Determine buy and sell signals using the MACD crossover or bounces off of a channel's lines. Learning to implement and recognize these signals help investors increase their profits when trading short and intermediary trends. But remember, life happens. Like life, trading is rarely black and white. Some rules that traders agree on blindly, such as never adding to losers, can be successfully broken to achieve extraordinary profits. However, a logical methodological approach for violating these important money management rules needs to be established before attempting to capture gains. In the case of the MACD histogram, trading the indicator instead of the price offers a new way to trade an old idea. Divergence. Applying this method to the Forex market, which allows effortless scaling up and down of positions, makes this idea intriguing for day traders and position traders alike. So MACD can be easily added into your trading strategy and used for many different approaches. You have divergence, you have convergence, you have crossovers, you have overbought and oversold indicators, all within this one indicator. So simply adding this simple indicator to your trading strategy means you can throw out a lot of other stuff. And before you know it, you'll be trading like a pro using MACD. So thank you very much for joining us. Have a good night. Again, go to www.tradetime.com and they have a whole bunch of education for you. They have all